Hey guys, in this video, we're going to talk about the poor man's covered call. Now, why would we want to place something that's less than what we could have as a regular covered call? Why do we need a poor man's covered call? Well, it's in the name. If you don't have enough capital to place a regular covered call, but you still want to participate and play this as a regular covered call, then you would play this strategy. So this is going to be for low IV environments because if it's in large IV environments, we might get whiplashed, right? And it's going to be harder for us to kind of take advantage of the management style that we can use, which would be rolling that short strike, okay, either up or down or in or out, whatever we have to do. We talked about that in other videos. But in lower IV environments, and when it expands a little bit, we can take advantage of that. But high IV environments, we're getting a contraction, and that short strike is actually becoming more and more worthless. So it's giving us less leeway. We're going to have to get tighter and tighter on our spreads, and it's going to kind of screw everything up for us and basically give us less of a chance to make money on that spread. So low IV environment, and let's just say you don't have the capital to purchase 100 shares of. We're in Kroger right here, so we don't have 100 shares or 100. We don't have enough capital to purchase 100 shares of Kroger here at this strike price. All right. But we still want to play this as we're playing just a regular covered call. So what we do in here is actually it's going to be two different legs of a spread. So it's basically more or less just going to be like a normal kind of spread for us. So either debit or credit. And it's just going to be two different strikes in two different expiration cycles. All right. So you're going to kind of look at this as just a normal debit spread. All right. And our normal strategy, how we do this is we buy an in the money call and then we sell further out of the money call, or we buy it in the money put and we sell further out of the money put. Those are going to be our normal debit spread strategies. And that's what we're doing, only we're going to do that in two different cycles. And actually, what's going to be different about this, the diagonal spreads, you can do them however, but for a poor man's covered call, you actually place the short leg in the near term expiration. So we'll go in here, we'll sell a call here in August 20th. All right. So we're going to go ahead and we'll keep it here. We'll sell this $40 dollar call strike here for right around, what is this, 72 cents, 69 cents, something around what, oh yeah, 69 cents. So we're selling the 40 right here. So what we're saying is Kroger's going to go up, but it's not going to breach this $40 mark here anytime soon. You don't have 70-cent move by August. I think it's going to come down a little bit before it goes up. And then what you're saying, what we have to do for this poor man's cover call is you would think that you would be buying a really, really short term call, but really we're going to go further out. So we're going to go further out in time and purchase a call. So we're selling in the near term and you're buying in the long term. So we're going to go out here to September and we're going to purchase a deep in the money call. So we'll go ahead and we'll purchase this 35 right here just for an example. So we're purchasing this for right around $4, and we're selling the that 40 in August for right around 69 cents, etc. So more or less, when it's all said and done, we're trading for right around 395 bucks. So it's going to cost us 395 bucks to play. Whereas if we're playing a regular covered call, it's going to cost us $3,900 because we have to buy 100 shares and then we have to sell that call against it. And if we sell that call in August, we're only collecting 69 cents. So you're putting up $3,900 just to try to make a little bit of your cost basis at 69 cents. Whereas this, you can just play $395. So we have this strategy on. So now what? What happens? Well, as you can see here, we really have no idea what our break evens are. We don't know what our max profit is. We don't know what we do know what our max loss is. But that's really all we know. We know our delta is 46. So we're always going to be long. And we know we're long veg in here. We're looking for an expansion of IV to the upside. Okay. But that's really all we know. And that's because of IV. And it's because of the IV in the different expiration cycles. So when we're in the same expiration cycle, we have a good, we can guess, I guess, well, not guess, it'd be calculate the IV and the contraction and see where that short call would end up at expiration compared to the long call. But because our short call is going to be in that near term expiration, we really have no idea even on August 20th at 3:55, we know where the short call will have a chance of ending up, but we really have no idea where that long call will be, and how it's going to offset our gains or how we're going to make all our money. So, what we're looking for in this strategy, we know that we can't lose more than that $395. And what we want is we want a move up, obviously. So that's everybody kind of thinks when you play covered calls or poor man covered calls that you don't want to move up. No, that's what you want. You want the stock to go up. Um, so in that, what happens is when the stock goes up, is that this deep in the money call, well, it doesn't have to be deep. It's just for this example, we're here at the 80 delta, is that the strength of this delta will increase, and that will increase, it'll offset the um call that we're selling here. So even though this price will increase because obviously we're getting closer and closer and maybe we even breach the 40 mark, the long delta will offset that and we will be making money. Now if we do get a move against us, right? So if we get a down move, we will be losing money, but we will be we will be making money here on this short call, which is going to be the 69 cents. All right. So even if we do get a down move, obviously we're going to lose money on this call here in September, but we will be making money here on our short call. And if we go down to, let's just say we go down to 35. All right. So, and we're getting close to August and we're down to 35. We have a couple of weeks from expiration. You know what? We can go ahead and we can use this short strike. Usually we want the short strikes to be mobile. So we can use this short strike and we can roll down. We can collect a little bit more IV. So we can go down and roll down to 38. We can roll down to 37 if we want to, just to reduce our cost basis even more. You know what I mean? Maybe we can chop this 400 down to around 300, right? Or a 250, and then keep on rolling down, and still stay in this expiration cycle just to reduce our cost basis. Because that's kind of what it's all about when you're trading, right? It's all about controlling what we can, and that's the cost of what it of literally what it cost us to place these trades and strategies. So that's how you manage it to the downside. To the upside, obviously, that long call will offset all the what you're missing here on the short call, but I will be honest, be careful with how deep in the money you go with these. You want to do it in very, very liquid stocks because once you get up here close to the upper 80, 90 deltas, your volume sharply decreases, especially in some stocks. So be careful. You don't want to just keep on holding on to this and be like, oh, look, you know what I mean? I'm making money, so I'm just going to leave this here. No, because maybe you can't get out of it. So you always want to do these in very, very liquid stocks, low IV, and then most of the time IV will decrease when you get a move up, but you will get a large move in your delta here. So that's that strength of that delta will move your debit strategy to the upside. So yeah, that's a poor man's cover call. Basically, all you're doing is you're selling a short term out of the money call and you're buying a longer dated expiration call that's in the money. And then you're just still playing how you would with a regular cover call. You want an up move. The only problem is you do have time running against you, whereas the stock, you have that static delta with you, you have that 100 delta built in with you. Here you're using that dynamic delta of that in the money call, so obviously that has IV built into it, and that's why we're having a hard time calculating your max profit and your break evens, because you don't really know how that IV is going to affect things as we get closer to these expiration cycles. But again, just to reiterate, you're selling that out of the money call in a short-term expiration. You're buying a further deep in the money, further expirated call, and then that is going to be a poor man's covered call. Sorry for rambling on there, but hopefully that made sense. If you have any questions, feel free to reach out and we will let you know. All right, guys, thanks for watching. Make sure to check us out on our social media. We have attached the links to our socials in the description, and we also have a trading service if you're interested. There's more information in the description below.